Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Netflix's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 300 billion market cap. They're trading at $7.01 a share, their all-time high, and they have 429 million shares outstanding. Netflix offers streaming TV, documentaries, films, and games across various genres and across multiple languages. It operates in almost every country in the world. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Negative free cash flow in 2022. They invest heavily in content. Content is really expensive. Buying the rights to air movies and TV shows is the most expensive part of this company. They did have positive free cash flow in 2023, 1.6 billion, 5% margin. Then it blew up almost 7 billion in 2024, still close to 7 billion in the trailing 12 months. 20% margin, really nice margin. Net income is the profit or loss on the income statement. It's revenue minus expenses. That went from 5 billion to 7 billion. And they also have really nice margins in net income. Their net profit margin is 20%, which means they convert 20% of their revenue into net profit. Revenue is a sales for the company. Most of their revenue is subscription revenue. They're also getting advertising revenue because they started offering an advertising only option. Revenue grew from 30 billion to 36 billion. Not the best growth, but it is a modest growth and it's actually increasing. It went from 6% in 2023 to 7% in 2024 to 8% in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value with all cash flows past year 4, that's 259 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $225 billion. We divide that by 429 million shares. And we get a calculated stock price of $5.24. They're trading at $7.01, so they're trading at a 34% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. Simply Wall Street's valuation is $8.01. They say the stock is 12% undervalued. 39 analysts priced this stock at $6.94. They say it's slightly overvalued. There are 42 companies in the entertainment industry. And if Netflix has a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $340 million in CapEx, more than the average, but a lot less than Disney. Disney spends a lot of money on their theme parks because there's lots of CapEx. When they develop a new property, they have to buy buildings, build rides, really heavy CapEx spend. Netflix has a good debt to equity ratio. For every dollar of equity, 60 cents of debt. They do not pay a dividend. 6.8 billion of free cash flow, second to Disney. They're the largest company in this industry by far. They're probably almost as large as the other 41 companies combined. All their price multiples are worse than the median, so they do seem overvalued according to these ratios. They generate 36 billion of revenue, far behind Disney, slightly behind WBD, Warner Bros. Discovery, but they're still growing. Their 5-year annual revenue growth rate is 16%, a lot higher than the median average. Here's their latest income statement, the second quarter of 23, second quarter of 24. Revenue is up nicely from 8.2 billion to 9.6 billion. They seem to be raising their subscription prices each year, and that's really adding a lot of revenue. They also crack down on people sharing subscriptions, and they added the cheaper option, which includes advertisements. Cost of revenue, all the expenses directly tied to generating the revenue, is 5.2 billion. Marketing 600 million, technology 700 million, G&A 400 million. So operating income is up from 1.8 billion to 2.6 billion. They spent 168 million of interest on their debt, less than last year. Income before taxes 2.5 billion, 366 million of taxes. So net income 2.1 billion, up a lot, up about 50% from last year. EPS is $5, up from $3.35, and they're buying back stock. Last year 444 million shares outstanding, now it's 430 million. So to summarize, I have them trading at a 34% premium. The ranking is 7 out of 10. I think it's a great company, but I think it may be a little overvalued, or at least it's not as good of a deal as when I bought it a couple years ago at like $350. Would I buy it? 8 out of 10. I like them in the long term. I probably wouldn't buy it right now, but if it gets below 650, then I probably would buy it again. Ratio is 3 out of 10. They do seem pretty overvalued according to their ratios. Financials 8 out of 10. It would be higher, but their revenue hasn't grown that much, only up 22% since 2022. But their free cash flow is great. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.